Hi, I'm Ben Taylor, the CEO and co-founder at SoftLedger. We provide accounting software for companies outgrowing QuickBooks, particularly any with complexities like the need to account for digital assets. I'm here to talk about a growing problem in the digital assets industry, and that is the standardization of accounting data. And then I'll talk about how we plan to address that via the coalition. And so, yeah, there's if the theme of the last talk was interoperability, ours would be standardization for accounting data. As many of you are likely aware, blockchain data in general is not standardized from different data sources. And when it comes to accounting data, it's a complete mess. This may be fresh for some people who have just filed their taxes and did any digital asset trading in 2023. The point is, there is a need for standardization of accounting within digital assets. So I'll start off by talking about the history of accounting automation a bit, then how digital assets poses their own unique challenges, and then how we plan to tackle all this via the coalition. First, a history of accounting software. So, oh, got it. As long as people have needed to keep records, there's been a need to automate. And the innovations like double entry accounting were devised over hundreds of years, which led to significant improvements in accuracy and efficiency for financial record keeping. In the mid-1960s, computers enabled programmatic advances in accounting, starting with specific use applications. These systems could perform certain financial tasks in agricultural and manufacturing, for instance, but they still required this separate ledger to bring everything together. Then, in the early 1980s, general purpose accounting systems came to market, and these served as that ledger, the first accounting system that could really, the software application that could serve as the master record for all things accounting for an organization. A lot's changed since the 1980s, but general purpose accounting systems have not changed that much. There have been advances, of course, in like cloud computing that have allowed for people to be working in software applications from wherever they are, allowing for the easier exchange of data as well. But this industry agnostic system that accountants can use to take any type of unstructured data and make sense of it remains largely the same. Next, why is accounting difficult to automate? Every month, millions of accountants all over the world are tearing their hair out trying to close the books on time just so they have a couple weeks before they have to do it all over again. Maybe a bit dramatic, but we're talking about automating a process that is running monthly with sub-processes running weekly or even daily, the result of which are financial reports, salary payments, tax calculations that all need to be accurate every single time. To automate finance and accounting processes in a meaningful way is incredibly difficult to do. You can automate each component of the process and get mostly there, but still at the end of the day, there's somebody hemming and hawing over the numbers to make sure that they're right. Maybe you can get 90% of the way there with some careful planning and really carefully thinking through the process, but that last 10% is really the tricky part. Now, there are multi-billion-dollar companies solving things like billing, accounts payable management, taxes. These have done wonders to standardize legacy processes, improving accuracy and efficiency. Now, all of the aforementioned problems exist when we're talking about US dollars, British pounds, Japanese yen. Money has a standard set of rules and regulations that help simplify accounting. If you're holding yen, for instance, and it depreciates against the dollar, at the end of the month, you need to know your foreign currency rate so you can determine whether or not you need to take a loss. With blockchain-based assets, though, more information is required. So if you're holding Bitcoin, you need to know the quantity, price, and date for each purchase. That if you have a few transactions a year, if you're an individual, not such a big deal necessarily, but if you're an organization with hundreds, thousands, or even millions of transactions per month, spreadsheets just don't cut it. You can't do this manually. It isn't magic how source data turns into financial statements. It's a detailed, judgmental process performed by trained accountants with advanced degrees and certifications. Blockchains are automating accounting, meaning more transactions and very little in the way of standardization. And then this only gets more complicated as more complex use cases come up. Gaming, we have rewards, earning rewards, trading in-game assets, NFT, minting, sales, trading, tokenization of real-world assets like real estate, factored invoices, liquid staking, other DeFi use cases. We could keep on going on all day on these, and then when we're talking about the accounting gaps, even longer. But I guess the point here is any state change for a digital asset transaction means there might be an accounting event that needs to be considered. As the solution, I have the privilege of announcing the creation of the Digital Asset Accounting Coalition. We're a group of experienced financial, accounting, tax, and technology professionals interested in moving the digital asset industry forward through the creation of a standard schema for accounting for digital assets. We see this schema as a key missing component in the process for getting digital asset activity into readily usable information for creating financial reporting. I'm joined by Andrea Perlak of the Crypto Accounting Group, as well as Chris McMillan and Trent Martinson of Cavu Securities here today in the audience, and then also we have a few SoftLedger team members around as well. So if you're interested, please find us after. I didn't have the foresight to get our website up here, but we do have one. It's daac.network. That's daac.network. So thank you very much.
Questions for Ben?
Thank you so much. Fantastic presentation. I'm looking forward to diving into that schema. It's a little bit of a comment, but I'd love to hear your reaction to it. I'm really glad that you brought up the NFT trading and tokenization and fractionalization. Essentially, with all these features, barter economies can become a thing at scale again, which presents very interesting policy problems for some of my old colleagues. Choosing not to focus on that right now because the money transmission is enough. But I guess I'm curious, how do you feel that that's impacting you guys at all, or if you have any reaction to that?
So yeah, great question. I think when we get into the individual the specific transactions that need to be regulated, how they need to be regulated, it's just not possible to cover every eventuality in every regulatory regime. And so we've inherently built, we've very intentionally built things to be general purpose. And that's kind of the idea behind this schema is it's not going to be something that you just take and use to file financial statements in accordance with U.S. GAAP or IFRS. It's a schema so that any participant in the digital asset industry has a standard way of making sure the data looks so that accounting software, other downstream users can do what they need to with it. That's kind of the concept here. Because I think on the regulatory specific side, there's a lot of work being done to automate that. This just helps, serve as like the pipes to get it there.
Sorry, I appreciate the last question before lunch is nerve-wracking. Yeah. So in your development of accounting history, the one you didn't have on there that would be of interest to this audience was Lotus 1-2-3 and eventually Excel, which was this is stretching the analogy, which was an analogy to kind of blockchain in the sense of accounting data moved out of corporate into people's desks. And so for a whole while there was the person doing accounts payable that had a spreadsheet and the person doing accounts receivable that had a spreadsheet. And lots of the sort of accounting software that's come since was this, I need to get a hold of this accounting that's taking place only on one person's laptop and bring it together again. And so when thinking about these sort of this spread between I need centralized data, but I need individuals to get kind of access to it, it seems like it has this kind of natural tie to blockchain that's deeper than what you're saying.
Yeah, that's a good point, and it's still the case. Excel is so widely used. It really is a great system for what it does. It's just tough to connect to other other systems, and so that is. Yeah, if there's a meaningful amount of on-chain activity in a particular blockchain or a set of blockchains that could be standardized, and that's what we're bringing into the general purpose accounting system in our case, then there's a lot you can do. I think now it's just most of what we see is some is on chain on this chain, some's on a different one, some comes from a centralized exchange, some is coming from some step in the process of mining and earning via a pool or not, or where. So it's it's too much of a smattering of different sources to standardize yet. But I think that's exactly where it will head as there's more on-chain economic activity.
All right. Thanks, Ben, for choosing CMU to announce the coalition. And let's thank Ben again.
Thanks for having us.